Let's dive right into this explainer where we're going to completely demystify portfolio rebalancing and expose this hidden tax trap that might literally be eating your gains right now. You know how financial influencers are always preaching, trim your winners and buy the dip? I mean, it sounds like really smart, proactive management, right? Well, today, we are totally flipping that script. We're going to see exactly why rebalancing is way less of a simple math exercise and actually more of a strict engineering trade-off. And hey, here is a pretty provocative hook right off the bat to get us started. Trimming a winning position could silently demand a 12% price drop just for you to break even. Just think about that for a second. When somebody tells you to trim your winners, they're actually daring you to make a 12% directional call on the exact same asset you just sold. We'll break down exactly why that is. But first, let's do a really quick rapid-fire refresher on the groundwork.
Section 1. The basics of rebalancing.
Okay, so we probably all know the core definition, right? Rebalancing is simply the process of bringing your investments back to your original target allocation so you can effectively manage your risk over time. Fidelity actually has a really great analogy for this that I absolutely love. They say, if getting invested is like buying a car, rebalancing is the occasional maintenance required to keep the engine from blowing up. It makes perfect sense, doesn't it? Imagine you start your investing journey with a perfectly clean 50-50 split between stocks and bonds. That's your ideal risk tolerance. Everything is perfectly balanced. But a bull market happens, stocks outpace your bonds, and suddenly, boom, you drift into a 70-30 split. Without you lifting a finger or doing a single thing, your actual risk exposure has quietly skyrocketed. So what's the standard industry fix for this? Well, you identify the drift, calculate the difference, sell off your overgrown winners, and use that cash to buy your underperformers. Pretty straightforward. And you might decide to do this on a set calendar schedule, or maybe trigger it based on specific deviation thresholds, or even a hybrid mix of both. The whole goal is just to avoid over-tinkering so you can keep those transaction costs low. All right, moving on to Section 2, the hidden tax trap. So here is exactly where that standard advice completely falls apart. If you're rebalancing inside a tax-advantaged account like an IRA or a 401k, honestly, go wild. Sell your winners all day long. There are zero tax consequences. But if you do this in a taxable brokerage account, selling triggers capital gains taxes. And if you're a resident in a high-tax state facing short-term gains, that tax rate can easily hit 36%. Even long-term rates hover around 20%. That is some massive, massive friction built directly into the sell button. Let's make this violently tangible for a second. Let's say you trim 12 shares of a winning ETF, and you've got a $100 gain per share. If you're in that short-term tax bracket, you literally just handed $432 straight to the tax authorities. That money is just gone. It stops compounding for you forever. And social media advice rarely runs this math for you. Which brings us to Section 3, the break-even math. Seriously, before you ever hit that sell button in a taxable account, you've got to run a simple 3-step calculation to find your true round-trip break-even point. You find the per-share tax cost, calculate the round-trip price, and then determine your required drop percentage. Let's just plug in the numbers to see how this works. Say you sell at $300 with a cost basis of $200. Okay, so that's a $100 gain. Now apply our 36% tax rate. That gives us a $36 tax cost per share. Divide that by your $300 sell price, and you get 12%. The asset literally has to drop 12% just for you to break even. So if the stock drops 8% and you smugly buy it back thinking you totally nailed the dip, you actually netted less than you started with. The tax bill ate your entire trade. No way around it. Now, let's look at Section 4, the contribution rule. It all really comes down to one undeniable fact. Selling triggers taxes, but buying does not. And that brings us to the cleanest, most efficient rebalance lever in all of personal finance, which is the contribution first rule. If you're an accumulator, meaning you're still working, still actively funneling paychecks into your portfolio every month, you just use fresh cash. You direct all of those new incoming dollars strictly toward your underweight positions. You literally just don't touch the overgrown winners. Your portfolio will naturally dilute itself back to your target allocation, and you don't trigger a single taxable event. It's brilliant. The general rule of thumb here, coming from big institutions like Fidelity and the Bogleheads, is this. As long as your portfolio deviation is under 20% and the estimated tax cost of selling is over $500, just do not sell. Take your hands off the keyboard.
Just let your fresh contributions do all the heavy lifting over time.
Finally, Section 5, when to actually sell. Now, to be completely fair, being entirely tax shy has its own catastrophic failure modes. You absolutely must sell if you're facing massive concentration risk. Like if a 5% target suddenly balloons into 30% of your portfolio, yeah, one bad earnings report is going to cost you way more than a tax bill ever would. You also have to sell if you're a retiree facing sequence of returns risk. If you're drifting really heavy into equities right before you need to draw down those funds, refusing to trim just because of tax friction is really just loss aversion in disguise. So I'll leave you with this provocative thought. Before you blindly trim your winners to rebalance your taxable accounts, have you actually run the numbers? Do you know your required drop percentage? Or are you just handing your hard-earned gains over to the tax man for absolutely no reason? Run the math, use your fresh contributions whenever you possibly can, and keep your money compounding for you.